The Symposium project is an 11-month journey. We typically begin ramping up our planning in July as we form a committee to discuss content. I'd like to thank John Kolovos, Jamie Coates, and Annette Koberlein, as well as Tyler Wood for volunteering and participating in this year's Symposium Planning Committee. Thank you. Those think tank conference calls in July, August, September, and October really generated the bulk of the content for this year's conference. But our next session started to form about 12 months ago at our 2015 Symposium. Frank Teixeira pulled me aside and loved the fact that we were trying to get a deeper look at incorporating technical tools into the portfolio management process. Frank had about 12 excellent ideas, which we narrowed down to 2. But really, I'd like to thank Frank and Dave Lundgren for all their efforts in putting together this great session, as well as assisting with our closing keynote session today. This is a rare opportunity to catch a glimpse of how the Wellington technical team thinks about constructing a portfolio and analyzing the markets. I'd like to thank the team for providing us with this perspective of how you approach managing money and in their John Hancock Technical Opportunities Fund, as well as how they interact with other portfolio managers at Wellington. I'd like to welcome Frank Teixeira, Dave Lundgren, and Mike Murphy to the stage as they attempt to recreate their weekly Monday morning session. Thank you.
All right. Well, welcome everyone. It's good to see you all. A lot of familiar faces, a lot of people that we work with. I'm surprised to see people here who see me often because, quite frankly, I talk a lot, so. But thank you for coming anyway. I am going to talk less for a good part of this presentation, I promise. So in our group, I'm going to fill in some of the blanks. I have a technical group. Dave Lundgren's at the table. He's one of the members. Mike Murphy, sitting to his left, is one of the members. And I also have Guy Cerundolo, who happens to not be here. Somebody has to be at home watching the shop, and he volunteered aggressively to be the guy there. So it's us three, and what we do, so we have, we work very closely together, so that not a day goes by that we're not chatting. But we have some formal meetings. So we have a Monday formal meeting where we discuss, where everybody takes a little piece. So Dave will take the US and Japan. Guy who's not here takes Europe. Developed markets, ex-Japan, so it's not just Europe, it's Canada and Australia. And Mike Murphy does the emerging markets for us and some of the fixed income markets and currency markets. He has a background in fixed income and currency, so he handles that. The globe's a big place. It's a lot of information to cover, so we try to do it on Mondays. And then on Thursdays, we have another meeting, which is one of my favorites because we, and I think this might have been Dave's idea, although I'd love to take credit for it. Why not? Why not? I'll just take credit for it. We instituted a leadoff hitter for Thursdays meetings where we cover still the markets. We go into sectors and a little bit more specific stuff, individual ideas in the portfolios, but we invite someone for the street to be a leadoff hitter. So they dial in, they send in a presentation. Normally it's a 15 to 20 minute kind of conversation where they send something in and we sit in our conference room and it's up on the screen and they walk through the slides. It's really, really good fun. So we challenge them, they challenge us. It's a really good time. And then we do a globe charting presentation also quarterly. Some of the slides that you'll see or slides that we just presented this week, actually on Tuesday, to the firm. We call it technical globe charting. That's it, right? And it's globe charting quarterly. That's it. That's how I got it. Globe charting. It's kind of cute, right? You guys like that, right? Well, it's well attended. I think you'll enjoy some of the slides anyway. But anyway, so listen, I'm going to do something that I think our host might be aware, but nobody else in the room is aware of. As you can see, there are 5 chairs here. I will be taking one. There are 2 unoccupied seats. And I think to really recreate the feeling of our meeting and to recreate the feeling of having a leadoff hitter, I felt like, why not? I should invite a couple of leadoff hitters up. They are unaware of who they might be, so I'm going to scour the audience and have you come up and be part of the panel and just join in, challenge us, because this is really impromptu. I have nothing. I have absolutely nothing prepared. It's all like, hey, this is what I think, this is what I see, what do you see, why do you think that matters? And that's the conversation. So welcome to the meeting. I'd like to invite Luis Yamada up, please. Yeah. And so Louise still writes, and we still get her research. It's really wonderful to have her on the panel. And I'm going to invite a gentleman who has never been invited as our leadoff hitter, but was the leadoff hitter for my career. This is an easy one. Ralph Acampora, please come on up. Ralph, as much as I think we always love an invitation to talk to an audience. So I got a first taste of that way back when in the 80s when I took Ralph's class, and I think I've already shared this with you. He motivated me to pursue this as a career, and I happen to be one of the lucky ones who found a pretty darn good seat, and a lot of that thanks goes to Ralph. So I am approaching 20 years at Wellington Management. So just to give you an idea of what we do at the firm so that we can now transition to this, we manage about $1.4 billion in assets, all using technical analysis. And we also write research for the firm. So the other people that do attend our meetings are portfolio managers and analysts that are not CMTs. They're just interested in what we think about. So I am a big believer in the idea that fundamentals and economics drive trends. I believe that. So when a trend is in place, I always feel it's underpinned by fundamentals and it's underpinned by economic activity. So when I look at a chart, I try to make that leap in my mind immediately so that there's no disconnect between what I'm saying and what the portfolio managers and analysts at Wellington are saying. All right, so we're going to go now and get this party started with Dave. He's going to go through his normal presentation slide, and while he's speaking, we will challenge some of his assumptions, okay? So enjoy.
Is this working here?
Hello?
The mic is working, yeah? All right, okay, great. Okay, so, Frank, you didn't do your opening.
Oh, you know what? I'll just do it from here, and I don't have to go up there. Okay, so these are some high-level observations of how we're positioned in the portfolio, how we're thinking about things. Managing money, I think, as some of you can appreciate, especially if you're managing any, a broad portfolio of equities, is hard, and what's even harder than managing money is managing expectations. So there's a challenge at every turn, and I went to a great presentation just before I got here, Gary Antonaccio on, what was it called again? Dual momentum investing. It was really excellent. And one of the things that I wish I had learned before that presentation was when you have a feeling and it's an overwhelming feeling, lie down until it goes away. That was excellent. It's what I took away from the whole session. It was great. Anyway, so when you look at, we rely very heavily on relative performance. It's what we do. I think a lot of technicians do. So I think it's very difficult to come away with, anything other than overweighting the U.S. because the U.S. currently, as it stands, is the strongest market in the world. So by definition, if that's the strongest relative market, we have to be overweight, and we are. We are underweight Japan after being overweight for a couple of years, and the reason is you've broken some trends, you've broken relative trends and absolute trends. It's disappointing because after a 20-plus year bear market, I really thought we were on the doorstep of a pretty big bull market. Not necessarily terminal. It could just be a big correction in the inception of a bull market. I have no idea, but because I don't know, I have to exercise what I think a lot of technicians believe in anyway, is some form of risk control and some form of risk management. So we have moved to underweight. Europe, I don't know what to say about that other than Draghi definitely needs a bigger bazooka. That's all I can say because it's not working. Whatever's happening is not working. But the liquidity that Japan is pumping and that Europe is pumping must find its place somewhere, has to go someplace. And as we go through this presentation, maybe we can figure out where some of that is going. In emerging markets, we're still underweight. We've been underweight for years. Why? Because the absolute and relative trends are down. There might be some green shoots showing up there, and that's where Mike will step in when he speaks. And there, because there are some early signs of improvement there. And then, I know we've been through some presentations. The context of what we do is really, really important. I think it's I was at the presentation that Tim Hayes did this morning. He has also been a leadoff hitter and a great one at that. And the work that Ned Davis puts together is excellent, in my opinion. But there's a lot of on the one hand this and on the one hand that. And when it comes to managing money, we deal with a lot of that. On the one hand this, on the one hand that, and how do you weight those different things? And I think it would be very unusual to see energy and materials and industrials pick up relative performance without it being at the expense of staples and utilities and telecom. I mean, not everything can improve relative, but the context is what we care about. And since the relative context of energy and materials is down, and the context of industrials is probably neutral to improving, and the context of consumer staple and utility and telecom relative is up, it's hard for me to go with the nascent relative as opposed to the contextual relative. So those are our weights right now. Those are the areas that we favor. We also have some exposure to utilities, some exposure to gold stocks, which I'm sure if you're a technician, you probably like some gold stocks. I'm not 1 trillion% sold on the idea that gold is going to work. I don't have to be. It doesn't even matter, right? You acknowledge what is. I think if you've heard me in the past, we really take a lot of pride in just trying to really focus on what is going on, because I do believe what Kirkpatrick said last night is that, you know, I think a lot of us think we can forecast, but we just can't. We just think we can, and it's human nature to really, really remember the times that you got a forecast right and to completely deep six all the times you got it wrong, right? So the reality is, you know, if you follow the trend more often than not, you can't not be there. If the trend is up and you're there, and that ends up being a big trend, well, guess what? You're there. And we are high in cash. This year has been difficult for anybody who's a trend follower because we had a momentum crash earlier in the year, a very big sharp rally, all still within what you would call a 2-year neutral range on the S&P without any contextual change in the trend, right? So, and we'll address some of the things that we think have improved or not, but suffice it to say that cash levels right here, right now, are fairly high, waiting for more inflections in trend. So that's my slide, and I'll turn it over to Dave now.
Okay, so this is a composite of many of the different trend elements that we monitor. So at the top you see the S&P 1500, and then below that you see three lines. The dark green line is a composite of the multiple ways that we measure trend, whether it be moving averages, moving average structure, higher highs and higher lows, a couple of time frames, some relative performance and momentum, all sort of captured into one indicator. That's the dark green line. And then the light green line is a composite of the momentum being experienced within that trend structure. So you have, you know, positive trend with negative momentum is a correction in an uptrend. Negative trend with positive momentum is a downtrend experiencing a counter trend rally. And then the gray line is a very much more shorter term oriented overbought oversold type of indicator, much like you would see like in Williams percent R or stochastics or RSI or things like that, and some other proprietary stuff that we do that it is proprietary, but we can certainly discuss it because it's ours, right? Okay, so you know, when you think about the discussions you've probably heard since you've been here, there's certainly a tension that you can feel and hear in the different opinions between whether or not we're in a bull market or bear market. And I actually think that this chart does a very good job of sort of bringing to life that tension. So again, the dark green line shows you that when you go through a roughly 2,000 stock universe in the U.S., you're looking at roughly 32% of the market has negative trend structure. So think about Dow theory, talking about the primary trend, usually measured over months, if not years. Higher highs, higher lows defines that trend. Think about that conceptually. When you look at the world, at least in the U.S., and you go through that exercise, you find that nearly 70% of the market has a negative trend structure. Obviously not a risk-on environment, at least from this perspective. However, within that framework, you have this light green line, which is showing an extreme momentum surge in that context. Therein lies the tension. So have you seen the latest movie, Batman versus Robin? Right? I mean, I love both of them, right? And I hate to see these two guys fight each other. That's kind of how I feel in the market because I love trend, I love momentum, and they're kind of like duking it out here. And you know, the good news is at the end, if you haven't seen the movie, I don't want to spoil it for you, but
I haven't seen it. Don't spoil it.
You know, if this spoils it for you, you have other things to think about. In the end, they come back together and they're friends. So we suspect that in time, momentum and trend will come back together and be friends again, and our job is to be on the right side of it. But until such time, as we're watching this movie play out, it's a lot of tension. And it's not clear exactly who's right here, because one of these two aspects of trend is going to be right. And the balance is, when you look at the dark green line, that's what the market looks like at the end of every major bear market. It's exactly what it looks like. So from that perspective, you should be mindful of the possibility that as bad as it looks, guess what? You've planted the seed for the next bull market. Equally important, however, is also the idea that prior to every stock market crash we've had, this is what the market looked like. So I'll just leave that with you, and Mike, I'll turn it over to you. So again, but that's the tension. And so because of that, we're always very tactical in how we think about the market and how we make changes to our allocations in the portfolios. But that tactical nature of the decision-making process is paramount today, because you have this very strong counter-trend rally that when you look back in history, I think, of course, Lowry's has done a tremendous job in highlighting this for us over time, that when you get these momentum surges like this, it's typically the beginning of the next bull market, especially if you've had a washed-out condition like this. So when like we just had lunch with Katie, and she asked everybody at the table, are you bullish or are you bearish? And it was kind of a survey. And when the survey was over, Frank and I looked at each other, and he said, did you raise your hand? I said, no. I said, did you raise your hand? He said, no. Because we don't think like that. We don't try to label the market bull or bear, because we all know that investing is behavioral. And once you label something as such, it's extremely difficult to remove that label and put something else on. So what I'm thinking about when I look at this data here is that I'm cognizant of the idea that this could be a really bad outcome down the road, but until the tactical nature of the trend, which, believe it or not, it does give you time to adjust and adapt, until this begins to deteriorate and these trends that we've seen take shape off the lows begin to reverse, I think you're better off going with that tactical trend that's in place right now to the upside, and on the assumption that what we've seen is a major bear market bottom, and this first thrust off the bottom, which whenever you have a big bear market and the market gets extremely overbought, and everybody says this is got to be the best sell signal in this entire bear market because it's the most overbought we've been since it started, it's actually the opposite. Our experience is that when you have an ongoing bear market, you don't get overbought. That's the definition of a bear market. And when you have an overbought condition like this, you have to be very aware of the possibility that this is the start of the next bull market. So yes, it's very overbought, but as I have it labeled at the top, U.S. Trend Composite, too overbought to be bad. And that's how I would be leaning currently. Yep. There's your microphone.
This is where you chime in.
That's where I chime in.
Be nice.
The one thing that I don't see is, unless I'm missing it, I don't see a positive divergence at the bottoms here. Is that something I should be looking for? The way.
So, yep.
Yeah.
So there is one, and I will try to point it out here, but the light gray is that stochastic in RSI. So the low is right there, and this low is here in relation to that.
Okay.
But and you're right.
Sure.
You're right to point out that there is no divergence in the bigger indices or indicators, and that's because they're a composite of many different things, including momentum and moving averages, which, as you know, are lagging indicators. So this can actually tend to go right into the lows and be more descriptive of what's going on, which you can probably get that from just how you feel in your stomach as it's unfolding, that it's not good. But this indicator just kind of visualizes it for you. You can see that it hasn't really diverged in the past either. Certainly in the dark green one. The light green one, which is the momentum within the context of the trend, does have a better record of diverging. But look, the other elephant in the room here in talking about divergence is when you look at what happened from 2012 all the way through 2015, you had a very strong market at the index level, but we can see that dark green line was highly divergent as it unfolded. So we all talked about that divergence unfolding as the bull market went along, and here's a pretty good graphic depiction of it. Again, using a composite of different ways to measure trends. So that divergence was obviously very obvious, but it was also, if you began to respond to it when it started, this is the challenge of divergences. So, I actually teach the class at Brandeis, and one of my students is here. There he is there. So I got to check, make sure everything I say is by the book. But when I teach them the idea of the different ways to think about the technical approaches, there's, much like economics, there's leading indicators, there's coincident, and there's lagging, right? They're all very valuable, but you have to be mindful of which one you're using when you're using it. And this momentum type work is a leading indicator. And leading indicators are almost always right, but they're also more often than not wrong. So that's the definition of leading indicators. And so divergences, how's that one for you, huh? That was not in the book, by the way. But you get the point. So these divergences can be, they're important when they're important, but until they actually get technical confirmation, you have to just be mindful that they're there.
Hey, Dave,
Yeah.
I went to a fantastic presentation last night, technical presentation. And I got to tell you, these guys were phenomenal. And I have to say that Paul Desmond made a very convincing case about his operating company's breadth. How does that fit in with this little picture you're giving me?
I would say it's very comparable in the sense that this is just the index up above is the S&P 1500, so it's a pretty broad representation of the market. What you see in the data below is the 1,500 plus names that should be in the 1,500 that aren't. A lot of IPO names, a lot of mid-cap names that just aren't in there for various reasons. So it's a very broad representation, but it's all common stock only. No ETFs, no bonds or anything like that.
All right, you passed.
Yeah. Okay, so I'm just going to go over a couple of the components of this composite indicator on this next page here. What we're looking at is if you again going back to Dow theory, which is to me is the starting place and frankly the ending place of technical analysis. But if you think about again higher highs and higher lows, he talks about 3 time frames: primary, secondary, and minor trend. You can go through the market, all 2,000 stocks that are in this composite, and isolate that trend-defining, primary trend-defining high and low. And then from there, you can just say, well, how far is the average stock from that trend-defining high and low? And that'll give you a sense for the overall health of the market. And what I want to point out here with that green circle is that the green line at the bottom is showing you how far the average stock is from its trend-defining low. So we're looking for momentum surges that are just too strong to be a bear market rally, right? So to me, this is, if you look across to the left, you see 2011. Off of that low, we had a very comparable surge in momentum off of that trend-defining low. Now, if you stay focused on this over here, this rally here, again, is what I'm pointing to. You'll notice that we did get a, who did that?
Me.
Oh.
Just trying to give people a lot more to see.
We did get a decent pullback, but again, the context is this. The preceding context is this, which is a very washed out. The average stock was over 25% from its trend-defining high, which is that red line. This is the green. The green line is how far it is from its trend-defining low. So we had this as a preceding. You planted the seeds for a bull market. Then you get this momentum surge. Again, you can't forecast anything, but you can go with the odds. So the odds you should go with at that time until the evidence changes is that you've just seen the lows. That's the argument I would make here, and then I would just point out that as this is unfolding, despite the magnitude of this rally here, the average stock is still 10% from its trend-defining high, which sets the stage for this kind of pullback, because you haven't quite turned the primary trend, the trend that matters most, the one that's driven by fundamentals. That trend has not changed yet. You can clearly see that at the index level. So again, another reason to believe that we've seen enough momentum off the lows, such that that's the low, and then from here we're taking a very tactical view, following the evidence as it unfolds, but generally want to give the market the benefit of the doubt. And then this is another component of the composite that I showed you here. This is, again, I just mentioned the 3 time frames of trend. This is a chart that shows you the percentage of stocks in each of those time frames that's in an uptrend. And here again, you can see the tension. The light green line is the percentage of stocks that are in a Dow minor trend up. Minor uptrend, and you can see that surge, which if all is going well, that surge should then be followed by a similar surge in medium-term trends, which if all is going well will then be followed by a similar surge in long-term trends. But as it stands today, you can see the tension because, again, the majority of stocks are still in a primary downtrend within the context of an explosive short-term or minor trend and medium-term trend repair. And it's that repair work that actually gives the rally the fortitude to withstand whatever pullback we get, because a lot of these trends in the medium-term time frame, so think about it like the 50-day moving average type time frame, in that time frame you've seen a lot of repair work. So when we do get a pullback, that's what it's pulling back into, that intermediate-term repair. And so again, given the context and the magnitude of the surge, the assumption we would make is that it's going to make it through that pullback, Ralph.
Oh, go ahead. Well, I was going to play devil's advocate here and just say that at the recent lows that we've had, you had energy stocks and material stocks off anywhere from 20 to 80%. They've had incredible bounces, but they're bounces off these lows, and they may be up 20% or 25%. But we can't anticipate that those are going to continue to be the leaders. And I'd also put a little Yellen effect maybe on that extra bounce that we've had there, which could take us into a new advance. There's no question about it. But I really question whether those depressed stocks are going to continue to lead.
I told you should have invited Slimer. I'm just kidding.
I will add to this only because, so that's the challenge, right? I mean,
Right,
it's on the one hand this, on the one hand that. I have not bitten from the energy material apple, and the relative performance there hasn't really been that exceptional. It's been okay. Where it's been better has been in industrials. And the issue that I have there, and I'm sure that, if you believe in what we believe in order for us to really engage more fully, and Dave and I have been having a lot of conversations about engaging only because, for the most part, we want to be engaged in things that are trending and outperforming. Right? And as the market breaks, like it broke earlier this year, what was it, 22% of the 200-day moving averages in the U.S. were still trending up, only 22%. It's very difficult then to get a trending and outperforming environment from that mix, right? So that's the challenge. And we've been thinking, look, trending and outperforming is a momentum discipline, and in a bull market, it's pretty easy. And the beauty of a bull market is it covers up a whole bunch of your mistakes. If you're making mistakes, it doesn't matter. Sweep those under the rug because you're making it everywhere else, right? As soon as the market breaks, all your mistakes, it's like everything you swept under the rug is showing up. It's all there. Like, oh, I should have put a tighter stop loss. I should have been a little bit quicker. It's like all these second guessing, right? You cannot be in this business and not second guess your emotions and your decisions and how you think about trend, right? But the reality is, when markets break and they start to turn like this one, we have no idea how far they're going to go. I doubt very much there's anyone in this room that was thinking, hey, we're going to rally 14% in a matter of weeks. No one, right? It was like, hey, that's a break. We're going to get a bear market rally, and then we're going to kill them again, right? Because this is the beginning of a bear market. It's so easy to see that, right? And you got to question your assumptions when it's so easy to see it, right? Like I always joke, Dave brought up a movie thing, and I was like, it's so hard to watch a movie, right? And I love watching movies, right? Without sitting there and thinking, I know what's coming next. Jason's in the woods. He's behind the curtain in the bathroom. I know he's in the closet, right? He's under the bed. It's so, right? Because that's what the music plays, right? And the emotions are, augmented, right? And that's what happens and that's what happens in a market. Your emotions get augmented at a certain point, but the context is what I struggle with, and I think that's what Luis is bringing up. But I will say this, and every strategic rally has to begin with something tactical. So at some point, you have to move away from the momentum philosophy because momentum's been broken. We've had a momentum crash, and think more tactically, and maybe that's when you implement technicals and say, hey, you know what, it's above a short-term moving average. I know the context is awful, but I'm going to engage. Some of the conversations we've been having, so I'm just showing you that that's the pull, the tug and pull. So anyway, go ahead.
All set?
Yeah, I was going to follow up on both of what you were saying. I think you're implying that we could have a correction here, and the correction is fairly shallow, does not make a new low. I don't want to read into it, but that's what I hear. Relative strength in that pullback, I think, is going to be even more important because the old adage is, in a market decline, the groups and stocks that get down at least are the new leaders coming out the other end.
Yep.
Any indication what they could be? Could it be some of the energy stocks that
Actually, I have a
my
chart on
friend
that
gave us?
because it's been something that we've been monitoring since August, actually.
So go ahead.
So we know that the volatility of the market began basically in August of last year, and there is a sector that has been very sneakily outperforming the market throughout all of it, even during the decline. And I'm going to keep you in suspense.
Good.
Okay, so
New leadership, huh?
this is an index that you all can access if you have a Bloomberg. And if you're a momentum investor, I think this is critical to monitor because it tells you what's happening, what the best performing stocks from a momentum perspective look like. And so if you think about a world where, if you're looking at this chart, again, this is the Dow Jones Long Momentum Index, and it's long the top quintile of 1,000 stocks that have the best 12-month performance. There's a little bit more nuance to that, but that's essentially what it is. And so you're thinking, okay, these are the best performing stocks over the past 12 months. That chart must look awesome. But when you look at the chart, and this is what it looks like, this is when we're forced to give you a definition of a bear market, this is how we define it. When the best looking charts in the market look like this, you know you're in a bear market. And until this index looks better, you are not out of the woods. So Louise, perhaps you're correct, right? So perhaps this whole thing ends up being a counter trend rally. And if it does, through the simple practice of trend following and technical analysis, we'll pick up on that reversion back into the downtrend again. But until such time, what we're monitoring for is an improvement in this index that would indicate that the leaders are leading again in a healthy fashion.
And this is Dave's forecast right here, which he should be penalized for because we don't forecast.
You can take that to the bank, actually. Okay, so the opposite of that is the Dow Jones Short Momentum Index, and not surprisingly, this index looks terrible today, and it looked quite rather negative early 2015, giving you a heads up in the beginning stages of that sort of bifurcation in the market. So we had the leaders still look fine, but the losers weren't losing by going up less; they were losing by going down in absolute price structure. That's the beginning of a divergence that matters. And so again, we're going to want to see, if we're in a healthy bull market environment, what we'll see is both of these indexes repair. If we only see one repair, and it's the leaders, then fine, that's what we'll own. And we'll be just mindful that it's not quite as robust and healthy as it was in 2013 when both of these indexes were going straight up. And so, Louise, again, getting back to your earlier point, it's quite possible, right? Without having to label things and think about what's going to be, just think about what is. It's quite possible that we end up with a scenario where the momentum index, the long momentum, looks fine, and this looks terrible, as a potential scenario.
Yep.
And then as this is unfolding, one of the things we're monitoring is this black line is the relative performance of a basket of deeply cyclical stocks relative to the market equally weighted. So you can see, we all know that this has been a bull market by most measures, certainly by rate of change perspective, and at least into the highs. And what's been most perverse about this market is that it's been led by very strange leadership. So you would think that in a bull market environment, that black line would be going up and to the right, because that's cyclical leadership. And in fact, that's not what we've had. And the overlay here is a proxy for inflation expectations. So you can get inflation expectations off of Bloomberg, but if you don't have Bloomberg, another way to do it is just calculate the ratio between the TIP ETF, which is TIP, and TLT, which is the nominal U.S. Treasury ETF. And directionally, when the blue line is going down, that means that inflation expectations are declining. And I just would note, the correlation between these two lines. And so it's pretty clear that the cyclical trade, which is what we all kind of think about in terms of being a normal bull market environment, that's not likely to re-engage and give us that sort of bull market that we learned about, years ago, until we start to see inflation expectations. So we could have a continuation of the bull market without it. But I'm just pointing out that if we get a resumption of the bull market at the S&P level and within, and this blue line is still not participating, then it's probably going to be more of the type of leadership that we've had over the past 10 years.
So hold on. So this is a chart that we've actually used with clients and prospects because it challenges the way we think about things, right? Because if I only showed you this chart and you knew nothing about the markets, right? I showed you the black line and said that's the performance of deeply cyclical stocks. You would say a whole bunch of things, but you wouldn't say bull market in equities, right? I mean, you wouldn't say it. That's the beauty of just aligning yourself only with what's going on because it's so easy. Look, I'll tell you a story. In 2004, at Wellington, we were looking at the chart of crude oil, and everybody remembers it, right? It had a big base. It was in the 30s. It looked like it was set to break out, and that was when I was pretty confident about my forecasting ability. I'm a lot less confident after an additional 12 years of managing money. And I was asked in the morning meeting, Wellington has a morning meeting every single day where portfolio managers and analysts attend. I was asked about what I thought about the chart, and I said, look, if this gets through 40, I'm thinking 60 or 70. No joke. The room broke out in loud laughter. Like, inconceivable. This is why technicians are knuckleheads. They say things that are just absolutely crazy, right? And there was one portfolio manager in the room who runs a hedge fund, and he said, wait, let's say that Frank's right? Because, let's say that oil goes to 60 or 70. that sounds really bearish. And then we went into a 15-minute discussion about who would be impacted most by oil prices going up, right? Again, same thing. If I showed you a chart of oil going back then, from oil going from 40 to 70, you would say, oh my God, this has to be really, really bearish for equities. Meanwhile, it ended up being really, really bullish for equities, but it ended up being bullish for emerging markets and crude and commodities and natural resource producers, and on we go, right? So, you know, and I'll add a little bit more color to this. When you look at when you look today, one of the things that we're challenged with is the bank stocks, right? I mean, how many think the bank stocks around the world have bullish technical structures? Anyone? Is there one person in here? Stop it.
on a 5-minute chart.
So here's the challenge, right? It's so easy to look at the charts of banks, right, you know, globally, particularly in Europe, and say, hey, I've seen this movie before. Jason's definitely in the woods, you know, and he's approaching the window outside the kitchen. I know this scene, right? And when I look at it, I say, well, the technical conditions of the market certainly looked much worse in 2008. Doesn't mean they're not going to get worse, but they did look worse in 2008 when all the bank stocks were leading on the downside. Is it plausible that the banks this time around, even though they're bad everywhere, even though they're bad, doesn't mean the world has to end again? Right? Just challenge your thoughts on it. Like, is it a systemic issue? It might be. But what if it's not a systemic issue and it's like crude oil going up, or it's like, you know, anything else? They say, well, wait a minute, maybe it's not bearish. Maybe banks just stink because their business models stink, right? I mean, they can't really lend. You know, they're regulated to death, right? I mean, negative interest rates in what? I think it's 40% of the world's GDP comes from countries with negative interest rates. That sounds like a bad formula for bank stocks, but does it have to be really bearish for the equity markets?
Remember, you used to actually, when we did presentations to clients, you used to say, actually, I don't forecast, but I do have one forecast for you. Rates will not go below zero, and the whole room would laugh, ha, ha, ha. They're below zero.
And here we are.
That's why we don't forecast.
That's why we don't forecast.
Okay. Okay, so I'm just going to quickly go through the sectors and how we'd be thinking about positioning from a relative perspective. So these are the I guess the 5 lower beta ETFs. So REITs, you know, sort of been in a triangle since 2009, since the lows, kind of nice rally, pullback, and then rallying a bit again. But beneath the surface within REITs, you can find plenty to be long and plenty to be short. It's actually a good opportunity set on both sides. Utilities, you know, they broke a meaningful downtrend. So my gut instinct is to say, well, this can't be good. Utilities can't possibly be in leadership in a bull market environment, which is invariably probably a good assumption to make, but I just want to point something out to you right here. Right? 2004 to 2007, utilities led a pretty strong bull market. So again, just go with what is. The market will figure it out for you. You just have to listen. Staples doing the very same thing. We have a relative breakout. So, you know, we can forecast that this is not going to follow through, and you can take positions opposite to it, knock yourself out. That's not what we do. But right now, staples are a leadership sector globally. Healthcare is the blue line. You know, obviously it's taken on quite a bit of water here, but it's hard to argue that trend is over. But you can you know, when you drill beneath the surface and try to build a portfolio, you can find plenty to be long and short. So it's somewhat neutralish. And then here's your financials. And again, here's the opposite of the utilities statement, which Frank just covered. That, you know, financials have been underperforming the market since 2005, depending on which part of the market you look at. And we've had a pretty bad bear market, a pretty good bull market, so a lot can happen with and without financials.
Can I comment on financials?
Please, yeah.
Yeah. Financials was one of the areas that really got us out of the market in 2007, because the monthly relative strength, and you can see some of it here, actually broke down under a 6-year support level. And I remember the media saying, oh, no problem. We had a financial crisis in 1998, financial crisis in 1990. And you went back and looked at the chart. 1998 was maybe a year. You saw a little top in relative. 1990, you couldn't even see it. And I said, you know, this is a 6-year breakdown. That's a major structural message. And needless to say, having gotten people out of financials, it was good. Now, I will say that our relative strength is very hard to see here. For the financials has broken down under a 3-year support. So it may not be as large of a problem as we had in 2007, but something's not right with the financials.
Can I make a comment?
Yeah, I would love that.
I'm just a simple guy who's been teaching trend analysis for 46 years. Excuse me.
You want this, Ralph?
This trend is wrong.
You want this?
This is not a downtrend. This trend is neutral.
Yeah, okay, fair enough. He's right. It's a neutral trend because the relative has not made a new low, right? The relative has not made a new low, but, what's that?
Did in our work. Is this a monthly or?
I think that's still above the lows
This is
there.
weekly. It is above the lows.
Yeah, but there are a lot of banks in Europe in particular that are well below their 2008
So in-
absolute and relative lows. But
financials,
the reality is, it's hard to, that could turn out to be a base, and Ralph is the ever optimist, so that could turn out to be that, and I'm certainly sitting here rooting for that to happen. The reality is, even if that's a neutral trend, the context is that neutral trend is preceded by a pretty ferocious downtrend. So a neutral trend and a downtrend, to me, is not something that I would engage with, and I don't think you would either.
Yeah,
You're,
and the
you're
other
just
thing-
trying to think it's not so negative because you want to support GE and Intel, but the reality is,
Please repair.
the reality is that's not great.
In financials, there's a lot of different sectors, I mean, industries within, and so when you look at the banks in specific, it's actually, it does look quite worse. In this particular financials index are the REITs, which is holding it up a bit as well, and insurance and exchanges and things like that that look actually pretty good. All right, so I want to just kind of fly through this here. So this is your discretionary technology, industrials, materials, and energy. So Louise, to your point, barely moving.
Yep.
Barely moving. Completely get that. So we're underweight. We have been for, as you can imagine, a very long time. But you can put into context everybody's excitement about how well energy materials have done since the lows. It's barely registering on this chart, so that's probably more important to point out. And then the other thing I wanted to point out, Ralph, to your question earlier, industrials bottomed in August of last year. So when you think about discretionary, this is 2008. This is what discretionary did in 2008.
Yeah.
Right?
Yes.
That's what the market's doing. It's telling you where the next leadership is coming from during the bad times. And we all know what happened with discretionary after that. So it's conceivable. Don't want to forecast anything, but because if that line breaks down, so will I. But not literally, but if this doesn't follow through, it doesn't follow through. But it's interesting to note that through all this volatility, with VIX spiking like it did and everything else, that industrials continue to outperform.
Yes.
Okay, so way more important, I think, than sectors, because each sector has their own factors within. Some aspects of sectors are growth and value and large and mid and everything else, is to actually look at the factors themselves. And here, when we're thinking about putting the portfolio together, we want to favor large cap over small, because small cap's underperforming. Growth versus value, low beta or low volatility versus high beta. We want to favor the more stable. We want to continue to favor quality. And then just, this last chart at the bottom is high dividends, high dividend payers with low volatility. It's interesting to note that for whatever reason, when the market bottomed here in February, dividend yield has been one of the best performing factors since this supposedly risk-on rally. So maybe, if we do, resume the bull market, maybe what we end up with is just another stable growth company type led leadership, and it's not the cyclicals. It's conceivable. I want to get to Murph here because he's got some really interesting and possibly encouraging things to say about EM for the first time since I've known him. So this, real quickly, is just a ranking of the industries. So this is on the left-hand side is the top 25 industries, and this rank is not just momentum, like how well did the industry do over the past 12 months. Within this rank is that plus what's the trend structure of every stock in that industry, what's the relative performance structure, and what's the breadth overall within that industry. So that's what gets you to these ranks. So these ranks are it's pretty difficult to get to 100, and it's pretty difficult to get to 1, but in a zero-sum world, somebody does it, and here you have them. And then in the middle, you have your sectors. And so this is how we'd want to be positioned from the sector and industry level. And so Japan is very similar. We can circle back to Japan, but we had been overweight for the first time in quite a while. We're back to underweight. We do manage a Japan-only portfolio, so it's a trend-following portfolio invested locally in Japan. We're at our max cash balance because of what we're seeing happening here. The slides are there for you to take a look at them. We can certainly circle back to them if you want to speak more specifically to Japan, but I want to turn this over to Murph to give him some.
I think
Actually, you're
Frank's
going to turn it over to me quickly.
Oh,
and
yeah,
then we'll go-
yeah.
and then we'll go.
You
But
get
I have this. Does this
Okay.
work? Does this one work as well? I don't think it does. Can you pass me that?
needs it, yeah.
I'm just going to cover Guy's slides really, really fast, only because I think it's clear. Which one do you hit? This one?
Yeah.
All right. I think it's
You can have to
clear.
go all the way through Japan.
Yeah, that's fine. I think it's clear where we stand on Europe. I mean, there are some good ideas there, but generally speaking, there are a couple of slides here that I think, well, this is the relative up here, right? Relative versus the S&P. This is the relative versus the ACWI. And this is the relative versus EM. It's taken a sharp hit here because EM has actually popped pretty nicely, but this is still the context of that correction. So the way we would view that is that there's still some wood to chop. This is interesting only because, and again, Guy in our group, and this is the beauty, we all think about things a little bit differently, right? I don't want to surround myself with a whole bunch of people who think about things the same. So he uses a lot of these, Ned Davis charts that he had made for them. They do this for him. They customize these. But it's pretty interesting, like here, this is 2011, right, in terms of the number of stocks that are, number of markets getting above the 200-day moving average. So, we had an explosion, as Dave showed you in the U.S., an explosion in momentum in 2011, and you could see it on a whole bunch of measures. You saw it here. You have not seen it yet. There's still zero, which is really, really interesting that at the index level, it's very difficult to find a country in Europe with, a market that's actually trading above, granted, declining 200-day moving averages, but they can't clear that. They can't seem to clear that hurdle. Here's some other ones. I think I'm going to skip that one. I want to skip this one too. And here, when you look at the factors that are working there, growth versus value, growth is still working. So growth is really outperforming pretty much everywhere in the world. And it's a real pain for active portfolio managers because they're constantly looking over their shoulder, wondering when is value going to turn, when does this good time end. And I think it's very difficult to argue that value turns unless you see something in the economy change. You have to have something change, right? Growth, economic growth has to expand and broaden for value to start outperforming growth. The reason growth continues to outperform is because we are still in a growth-starved world. No matter how much we want to look for green shoots in energy or materials or even industrials, the reality is there's just not that much that you can point to there. So this is a good chart. And then I'm going to skip this because, so this one here, the only one is the industrials here. Not much different than what Dave is showing, right? But at the end of the day, this is still not really, this relative here is not really trending and outperforming, right? Again, the challenge that I am running into, and one of the reasons is that one of the reasons that we have cash, one of the reasons that we're heavily invested in consumer staples, and we have some utilities and things like that. And I told somebody I think yesterday, I said, the problem with being long a whole bunch of staples is I don't fancy myself a staples buyer. I think of myself as much sexier than that, So I'm constantly looking for something more interesting than staple stocks. But it's hard to argue when you look at stocks like Coca-Cola or Colgate or Pepsi or Cisco, the food distributor, but down the line, it's hard to argue that those aren't massive bases that are breaking out and, for lack of a better term, trending and outperforming, especially when you look at staples in Europe, even firmer than they are in the U.S. This is the relative here, which is busting to new relative highs over this window. So this is clearly a trending and outperforming group. And this is, I'm going to skip that. These are all the sector work there. So even within Europe, I think industrials are showing up pretty well there. So, I think the way to think about things, as long as there are uptrends and they're outperforming, you should engage at a certain level. If the technicals in general aren't that supportive, you just size differently. And this is always the discussion we have. How do we size good charts in an environment that's not good? You size smaller. Should you not size it all? Well, it's an internal battle I have with myself all the time. And I talk to myself a lot. I don't know how many of you do that. It's a pretty healthy exercise, mainly because even though most people don't agree with you, you will never disagree with yourself. It's awesome. So I try to do that a lot.
Swing it over to Murph here.
Yeah, I'm going to do it to Murph right here.
I get that.
Oh, yeah.
All right, I'll be quick here just to leave some time for questions. As Frank mentioned before, I cover EM for the group, and it's been a challenge part of the market, to say the least. So I'm the guy that they stuff in the closet and kind of push food scraps under the door to. So as you guys know, those who follow the market, EM's had a crazy start to the year as well. And following that weak start, it was triggered by sharp decline in commodities, concerns about China FX, devaluation. Since then, the EM market has staged a pretty strong rally here, and it's now at an important juncture. From a bottom-up perspective, on the one hand, there are many systemic and heavily weighted stocks that are now overbought in a downtrend into resistance and look pretty vulnerable here. But on the other hand, there's an increasing number of stocks that have shown good improvement. A lot of positive price action, particularly from early cycle industries in countries like Brazil that have been in bear markets for 4 to 5 years. These stocks have broken above downtrends, broken above long-term moving averages. They've established higher lows. They've hit support levels and bounced. They've hit new highs on increased volume. So there are certain signs of improvement here that are very much worth mentioning and worth paying attention to. I think you've heard the theme about how difficult it is and nearly impossible it is to know if this rebound is another bear market rally or the beginning of a more sustained advance, and it's difficult to differentiate a short squeeze from a genuine and lasting rally. But almost all sustainable bull markets do in fact begin with something that looks like a short squeeze. And if EM is bottoming here, it's also very important to understand that it's a process that will take a lot of time. It'll exhibit a lot of volatility. There'll be a lot of fits and starts, sharp rallies followed by sharp declines. But throughout that process, we'll be looking for new highs to be hit, and again, resistance levels to be taken out, and just the germinating of a new trend. So we'll start with the chart here. Here's the 10-year chart of the EM index, and broader structure here is still pretty weak. There's still the downtrend intact off the 2007 high. The 200-day moving average is still declining. The index is still below the range that it had been in for the past 5 years. Now we're overbought against this weak structure, so I do expect some kind of a pullback here, but it will be this pullback that will be really instructive in terms of what we learn, how durable and lasting this rally could be. Again, we're looking for higher lows, holding important support levels, and then moving above long-term moving averages. So I'm cautiously optimistic on EM here, and I'll just show a few more slides from a top-down perspective that corroborate that. So remember that last chart that's 10-year weekly. Here's the same index over a very long time frame, back almost 30 years. And as bad as EM has looked over the past several years, particularly from sharp move lower last April to the low of this year, the decline actually found support at and confirmed the long-term trend off the 2002 and 2008 low. This level also happens to be the bottom of the regression channel spanning the entire history of the index back 30 years. So the point here is that there's technical evidence for a low. Now I know there's only 2 inflection points on that trend, so it could be nothing, but it could be everything, frankly. So just paying attention to it as a sign that a major low could be in. So here's the short-term view of that same index, just to show a couple important boxes have been checked on this rally. We broke the downtrend off the May 2015 high. We have a short-term uptrend in place. Now we're actually back above the 200-day moving average. Now I have to say that 200-day is still declining, so there is risk here for sure. But the only way to start flattening the slope of that moving average is to first rise above it. Here's a study done by Nautilus. Nautilus researchers do great work. They come up with a lot of these interesting studies on indices over time. So this piece shows forward returns to the EM index when it crosses above the 200-day moving average after having been below for at least 100 days. Now the 10 times that's occurred since 1987, 7 of those have resulted in positive returns, averaging over 9%. So, again, there are only 10 events in this sample size, a bit small, but there is some evidence when you take a step like this, moving above a long-term moving average after having been below for so long like it was. So here's, staying on the theme of the 200-day moving average, here's the EM index once again, but this was back in March 21st of this year, prior to the broad index actually getting above its 200-day moving average. You can see in the bottom panel there, at that time, greater than 50% of the underlying stocks had actually already risen above their own 200-day moving average. So there was strong breadth on the advance. It wasn't a rally driven by large cap stocks or the largest names that were already broken and had their own counter trend move and dominating the move of the index. It was actually good participation at the stock level. So here are all the country indices that have crossed above the 200-day. There's Korea, Taiwan, Philippines, Malaysia, Thailand, Indonesia, Brazil, Mexico, South Africa. You can add Turkey, Russia, Colombia, and Chile to that list. So the vast majority of EM countries have actually moving above their following 200-day moving averages. Again, the moving averages are declining. There's risk here. But if we want to stay in the positive improvement framework, I think there are a couple ways I see this resolving. One is through time. Price actually stays above these moving averages. We chop around sideways, relieve the overbought condition through time. And I think a more likely scenario, the second scenario I see is relieving the overbought condition through price. We have a sharp sell-off through the moving average. We find support, hopefully at a higher low, and then we continue on with the advance. So now here's the elephant in the room for this EM improvement scenario. This is MSCI China, which has vastly underperformed the rally so far this year. It's still below its 200-day moving average. And at 25% of the index, it's certainly a risk that bears watching. It's a huge contributor to the performance of broader EM. Now, China doesn't have to outperform for EM to offer opportunities to a global investor. I think it can't go down in absolute terms. It would have a severe negative impact, I think, to the rest of the complex. So, sorry? A couple more? Yeah, okay, we'll get through these quick. But if you want to step back and like the broad index, take a long-term view of China, it's actually corrected back to the uptrend from the 2002 and 2008 lows. Again, only 2 inflection points on that trend, but something to pay attention to. Just a macro indicator, this is EM CDS overlaid in yellow, inverted, overlaid on the broad EM index. As you can see on EM CDS in yellow, we broke a downtrend that was in place since 2014. We haven't broken that same trend yet in equities, so there could be some type of leading indication here. Here's EM index in white overlaid with cities economic surprise for emerging markets. So the good positive divergence here. EM economic surprises did not confirm the low, and were not as weak as the equity market would have suggested. So here is another indicator I've been looking at. This EM materials relative to the EM index here. And I bring this up because this is a segment of the complex that's been in a bear market, led into the bear market for EM, and now you're seeing certain signs of improvement where through a long-term moving average, through the downtrend, we're above the regression channel, we're hitting new relative highs here, and we're flattening out the slope of that 200-day moving average. Another important part of this is as I said, that the leading indicating possibility that it could have. So here's EM materials in white, showing further upside to the EM index. Back in 2000, this indicator led. It bottomed in 2000, whereas the EM broad index bottomed in 2001. Same thing for this is EM materials relative in white, and then in yellow it's EM relative to a global benchmark. Same type of leading characteristics. Bottomed in 2000, EM relative bottomed in 2001. Being asked to move along here. So here's just the broad EM relative to a global index, which itself is still in a downtrend. A lot of wood to chop here. Nothing really has changed except for that it's oversold from a long-term perspective, and when we take the other factors that are changing, could be at a low here. In fact, if you do look at the ultra-long term of that same chart, we've had a 62 Fibonacci retracement of the prior bull market, and we now have a positive divergence in the long-term momentum indicator. In terms of relative drivers within EM, trend-wise, it's tech, discretionary, staples, and healthcare. And then for factors, small caps still leading, and then growth still leading.
Just go back to the grid, Mike. All right, we're going to end it here, but I just want to say that Mike does this grid. He uses Bloomberg, and I know Bloomberg's here, and they have a great platform for creating a lot of things. But we think about the world a lot. This is only EM, but he does this for us for the U.S. markets as well, and we're always trying to make sure that we're in trending and outperforming, so you can see the relative trends, but you can see at the index level that you're not really fitting the bill on most of these in terms of trending and outperforming. but the reality is when we do see the combination of both, it's likely that we're pretty heavily invested there. I hope that was good in terms of taking you through the process. I wanted to leave enough time for some questions. If you have any questions for us, I want to thank Louise and Ralph for participating. No, please stay. I'm sure that. No, please stay. I'm sure there might be some questions for you, but thank you for
I have
participating.
questions for you, Louise.
All right, off we go.
Well, and we ask that you submit your questions through the app. It'll allow us to get through a lot more questions and get through them more efficiently. So first question here. Frank, you showed a relative chart of MSCI Europe and U.S. dollars against the SPX. Don't you think that picture is blurred by the euro-U.S. dollar component in that relationship?
Yeah, you go ahead. We have this discussion all the time.
We look at both. So, we're often asked, how do we deal with foreign exchange when we're managing a global portfolio? And the simplest way we can think of doing it is, rather than making two calls and possibly getting them both wrong, we just look at the overseas or non-U.S. names in dollars, because if the stock is strong enough to get through a weak currency such that it still translates well and still outperforms the global benchmark in dollars, then that's how we handle the foreign exchange question.
Yeah, that's the way I look. I could tell you several months back we were overweight Japan. We had a little bit more exposure in Europe, and we were hedged the currencies. Thankfully, we pull off of those currency hedges, and we're in unprecedented currency volatility waters here. So I don't know how to say it other than, if you're going to be in foreign markets, look at the chart of the currency and certainly be hedged. I think the yen was up 170 basis points today. I mean, it's just crazy currency moves.
In your chart pack, you'll see that in the Japan section, there's a chart that shows the rally in the Japanese market in local currency, and it's a beautiful, very strong rally, but it is into long-term downtrend resistance, so that's a problem for other reasons you'll see in the chart pack. But if you look at that same exact rally in dollars, it barely registers on the chart, so you actually didn't capture it unless you hedged. So we do monitor it both ways. We just presented it that one way.
Next question. Since you are more constructive on EM, you must be bearish U.S. dollar. Is that so? And if not, why not?
You take it.
Yeah, I think the dollar index chart actually has some vulnerabilities. I'm not keying my bullish EM view on what the dollar is doing, but I certainly would think that EM currencies appreciating here would certainly help the cause. There has been a situation over the past few years when EM has been chopping around or in its own bear market, where there have been stocks that have risen absolute significantly and just paying no mind to their really weak currency. So stronger currencies would help. I'm not making a forecast on the dollar itself, but I think if EM works here, the currencies would be helpful if the currencies work along with it.
And you've had some emerging market currencies break down trends, right?
Yeah, exactly.
Yeah.
Let's take a question from the audience. Anyone have a question they'd like to ask the team?
This is not really a question, but you were talking about the worldwide banks and all that. So just want to bring your attention to look at the Canadian banks, which are about to break out.
Coming from a Canadian, but no, you're right. That's probably the one part of the world where the banks look fine. I can't come up with another country where that's the case.
And while you go into the next question, just Ron, on the in that chart pack, I list the top 25 and bottom 25. I think it might be the case that you'll find the Canadian banks actually on that top 25. They may be just below it, but they're up in there and they're contending for leadership.
Up there.
Oh. Hi guys, I'm just curious, Mike, if you do any of the same work that Dave does with the trend factor and the momentum factor, and if it looks similar.
It's very difficult to get that data in EM because the data is just more scarce. I think when the data that I can get on momentum, it's followed a very similar pattern to that in the U.S. and developed markets. There has been a momentum crash. A lot of the trending and outperforming stocks last year came into the year and broke down significantly as well. I think the difference is on the other side of it. The more mean reverting stocks have actually just shown more improvement in EM than they have shown in the U.S.
Yeah, was up here.
All right, thanks. Here's a team question. So I see how you're your synergy and interplay, what does it look like when you pull the trigger? Is that something where one person makes the call? Is it consensus? After it's on, is it one person responsible because it was their idea, or is it a group decision? I'm just curious.
I think it's probably safest to have Frank answer this question.
Well, I do pull the trigger, so on pretty much everything. I do take a lot of the input, not just from Dave and Mike and Guy, but Ralph, Louise, and all the research that we get on the street. You know, it's when you think about the research that's out there, it's very interesting how somebody could look at the same exact picture and come up with, you know, we love to make, you know, really give fundamental analysts grief, but we could certainly give ourselves grief, right? I mean, there's one picture, here's the data, how come you're saying something, Ralph, how come you're saying something different than Paul? It's the same picture, right? So, and you know, and I think Katie also saying the same different thing than what Dave is saying. So my job, unfortunately, it's sometimes it's easy. Like I said, when the market is trending, it's really easy. When it's not trending like now, it's very difficult. I take full responsibility for pulling the trigger, but I try to take a compilation of all the information I'm getting and make the decisions as best as possible. I do think that it's important to just roll back a little bit and say one thing, that the most difficult thing is to sit at your desk and not have a view. All right? And it's really challenging because you want to, you know, you want to say you're bullish or you're bearish, and we try not to do that because I don't think it adds to the portfolio management process. If anything, it probably detracts from it. So we try to take a lot of information one stock at a time, and if we do that well, ultimately we'll get invested. And I've had a really difficult time here in this January-March window because I'm a trend follower. But I will say this, and this is what I'll say to my clients, because there's going to be some meetings, I'm sure, so I can forgive myself for missing this, right? Because this is a short microcosm in time. It seems like forever, but it's a short window, but I can't really forgive myself for missing this. So if this ends up being the outcome from this, hallelujah, so all good, right? So that's where I am right now. So uncomfortable in cash, but still recognizing the idea that while the U.S., and then Dave did a good job of showing you the data there, looks certainly much more constructive. And EM, a couple of green shoots here and there. If that's right, it's very early, right? Net, there's still a lot of wood to chop in global markets. And quite frankly, look, declining 200-day moving averages in the U.S. has gone from 22% to 33%. It's hardly a ringing endorsement of off we go. But I do remember what Tim Hayes said this morning. He's absolutely right. That'll be the last thing to turn trend. But I'm okay with that too. Yeah,
Next
Paul?
question to follow up on that, Dave. Dave, in your U.S. trend composite, what moves the needle for you to commit to either end of the bear or start of the bull stance?
That's a trick question because you're trying to get me to label the market, right? Who's Danielle? Shame on you. So, again, I'm actually struggling to answer this question because I actually don't think like that. So I'm actually trying to come up with a crafty answer here. But I mean, at the end of the day, what we like is trending and outperforming. And to the extent that we have so many ideas that we don't know what to do with ourselves, you're in a bull market. To the extent you don't have that, you're in a bear market, right? So take that definition for what it's worth, but that's how we define it. And, you know, if you think about what happened, Frank has actually a very good illustration in his own career when 1998 to 2000 unfolded, and all my data, all these charts look terrible. Mm-hmm. But that was the stealth bull market that we all know about, right? That was when biotech
TMT.
as well, but TMT basically took off, and that was the internet bubble. And rather than labeling and acknowledging that, yes, indeed, we were in a bear market, and many value managers back then knew that, and it was palpable to them. You know, Frank just executed the process and just bought what was trending and outperforming without thinking about labeling it one way or the other, and he did just fine.
Yeah. I know we have Louise and Ralph up here. My suspicion is, and I know Louise is presenting tomorrow, right? Mm-hmm. My suspicion is you haven't bought in here yet. You're not really inclined to believe what you're seeing, and you're sitting right next to someone who's very inclined to believe what he's seeing. So I just think it's very interesting, right? We have two people who've been doing it a long time, and they're looking at the same data, but one is more inclined to have a different lens on it than another. But if you engage with what is, I think you could both agree that you can still be invested whether you're bullish or bearish.
Well, there's times when the things are ambiguous.
Yeah.
Things are ambiguous.
But you can find ideas still, right?
Oh,
just
yeah.
less so.
Ideas. I think,
Lots of
and I'm not speaking for Louise, but I think in this, we're going to have a short-term correction, and I think we started it already.
Well, you just said we're
Yeah,
down
I think the
200
Dow is
points
down, I
right
looked
now.
at, Dow is down over 200 points right now. I think this is going to be the test. This is the correction, okay? If it holds, guys, and we don't take out those lows, you're going to have to be bullish.
We'll see.
Paul, did you have a question?
Or conversely, if they don't hold.
Yeah.
Oh, okay. Well, remember, that's a, that's a fraction in time. It's that. What's happening today, while it might, it might bring out a whole bunch of emotions, lay down until it passes. All right? All right. I want to thank everyone for sitting in. Thank you so much.
Thank you so much.
Thank you so much.